What's up guys, Nick here, back with another video. If you've owned GM stock over the past year, it's been a pretty crazy one. At one point hitting a low in March 2020 of $18 per share, and then surging all the way back up to $53 per share, an all-time high since the 2010 bankruptcy. With all of the buzz around electric vehicles taking over the entire automotive market, and GM's big announcement to go all electric by 2035, I thought now would be an interesting time to take a look at how well is the business really performing, and if GM might be a company worth buying stock in. So GM was the world's largest automaker from 1931 to 2007, with about 50% market share in the US. Currently, its four major brands are Chevrolet, Buick, GMC, and Cadillac. In 2009, during the Great Recession, GM fell on hard times, having to file Chapter 11 bankruptcy. In a Chapter 11 bankruptcy, the business will continue to operate, but it will have to reorganize and create a plan to take care of its debts as best as possible. A new company was created called GM Motors Company LLC, while the old company changed its name to GM Motors Liquidation Company. The old GM company sold assets and some of its subsidiaries to the new company. All of the shareholders who owned the old GM stock, now Motors Liquidation Company, lost out. The shares that were trading at $40 just 2 years prior in 2007 were only worth $1 now. GM had to go through the whole business and figure out what was returning profits and what wasn't. They also had to work to streamline its internal finances, so departments weren't directly competing against each other for resources. Since then, GM has returned to number 7 in global auto sales, and in North America, where GM generated 80% of its revenues, they're back to number 1 with just under 3 million vehicles sold in the region and about a 17% market share. It should be no secret that the current plans for the future of vehicles seem to be in electric vehicles. GM made a huge announcement in January of 2021 that its goal is to exclusively offer electric vehicles by 2035 and end its production of cars, trucks, and SUVs with diesel and gas-powered engines. Now personally, I think this is a great goal, but I do question just how likely it is that they'll have no diesel or gas-powered vehicles in just 14 years. But the world can certainly change a lot in that amount of time, and if I think back 14 years ago to 2007, I remember thinking that the way of the future was going to be cars running on French fry oil. Right now the Chevy Bolt is GM's main electric vehicle. It's an affordably priced coupe that first came out in 2017. In the first year it sold very well, but in 2018 sales fell and have since been flat or on a slight decline. This is more concerning when we consider that electric vehicle sales have been growing over this time period. Tesla blew past the Bolt with sales of their Model 3 and Model Y. And if I had to guess, I feel like the problem is the Bolt isn't anywhere near as exciting as the Tesla. Tesla is fun, it's cutting edge, and overall it benefits from much better branding. The Bolt feels like a regular coupe priced up about $10,000 higher than I would expect that car to cost if it was powered by gas, and then they just put in an electric motor. Now GM recently announced the new Chevy Bolt EV that will come in at $5,000 cheaper at $31,000, and then the Bolt EUV, which is an SUV starting at $41,000. They're expected to have a slightly improved range to 260 miles from last year's 238 miles. One of the big changes will be the option to add GM's Super Cruise for $2,200. Super Cruise is GM's hands-free driver assistance program, similar to Tesla's Autopilot. I think this new version shows some effort to create a more futuristic-looking electric vehicle, but I'm not really convinced yet that it will take much of the market share from Tesla and the Model 3. The Bolt EV is about $5,000 cheaper than the Model 3 if you don't include Super Cruise and Autopilot. And when you factor those two options in, the Chevy becomes $14,000 cheaper. Now GM has some pretty interesting premium electric vehicles coming to the market. 2022 should bring us what has to be the most ironic electric vehicle, the GMC Hummer EV, followed up with a Cadillac Lyriq in 2023. Now I like bold moves like this, bringing back a vehicle with some real star power, the Hummer, and then modernizing it. It seems to be working out so far for GM because the first edition trim Hummer sold out in 10 minutes. The Hummer EV will cost somewhere between $75,000 to $110,000, and the Lyriq is estimated to come in the $50,000 price range. So let's take a look at GM's finances and see how well they're actually performing. When we look at the revenue, operating income, and net income, we can see a decline in revenue that seems to start around 2016. The current CEO, Mary Barra, took over in 2014, and as I mentioned earlier, GM was looking at what was making them money versus what wasn't. Even though revenue declined, we should see it as a good sign that they remained profitable, which means they were getting rid of dead weight in the business. In 2017, GM sold its European business for $2.3 billion billion after 20 years in Europe of not producing a profit. One report found that Opel and Vauxhall brands lost a combined $18 billion over 16 years. When we look at their expenses, we can see just how expensive it is to manufacture cars, with about 80% of their costs going directly into the cost of revenue. The other operational expenses are made up of interest expenses generated in the GM financial business. This provides loans to consumers who purchase GM vehicles, and the overall segment was profitable, so these expenses aren't too concerning. The other expenses are the general and administrative expenses. Now, looking at their major three segments, GM North America, GM International, and GM Financial, we can see just how GM North America really dominates the whole business. They only recorded very slight profits or losses in the international segment, and GM Financial, which didn't show any growth, did record a consistent $2 billion in profit. GM has been looking to grow internationally with a specific focus on China, but this is going to be a huge hill to climb. There are some that believe China's aggressive effort towards cutting pollution and getting rid of gas-powered vehicles is what really pressured GM and the rest of the world's automotive manufacturers to focus on producing electric vehicles. But GM has had a little bit of a breakthrough recently in its joint venture with Chinese companies SAIC, not the US company, and Wuling. The Wuling Mini is a $4,500 electric vehicle that would remind most Americans of the smart car. If you watch reviews on the Mini, you'll see that it's extremely cheaply designed with a no-frills interior. The target market is young Chinese city residents who have very short commutes in city streets that really just need to get from point A to point B. Their competition is with motorcycles and other small vehicles, and not really the electric vehicles produced by Tesla and NIO. It has a range of 75 miles and can actually charge on the 220-volt 3-hole plug, which is standard in China. There were some questions on if this vehicle will be something that's eventually exported to Europe and the US, and I don't necessarily see this as very likely because the design would likely need a lot of changes to meet US and European safety standards. The Mini currently doesn't have any airbags, and I would guess that the frame lacks some strength, considering that they had to say that the body is made of 57% high-grade strength steel. Okay, so let's take a look at the valuation. But before I do that, if you could just take one quick second to scroll down and hit the like button, I would really appreciate it. These videos do take a lot of time and effort to research and produce, and it really helps me out if you'd hit the like button. So here's GM's forecasted revenue and earnings. Analysts are projecting a return to revenue growth with $138 billion in 2021 and $146 billion in 2022. They're projected to make $7.6 billion in profits in 2021 and about $8.9 billion in 2022. So I think with GM, as they move towards selling electric vehicles, it means that they're going to sell less and less internal combustion engines. I think an appropriate growth rate for GM is somewhere between 0 to 5%. This gives us a fair PE between 9 to 15. We just got the final numbers for all of 2020, and they earned $4.33 per share. This gives us a valuation between $39 to $65 per share. 2021 forecast GM earning $5.33, which brings the valuation up to $48 to $80 per share. Analysts see 2022 bringing $6.17 per share, which gives us a valuation between $56 to $93 per share. Looking at this valuation on a chart all the way out to 2025, GM at the current share price has a potential 2025 upside to 12 to 87% returns, with the estimated midpoint around 50%. The top end of this valuation is only really likely if GM is able to show some sustained growth, and the bottom end is if things just continue relatively flat as they have. I do think that both the top end and the bottom end valuation numbers are extremely realistic for GM going forward. I think that there's a lot of optimism around electric vehicle car manufacturers, but there's only so many cars out there that people are willing to buy, regardless of what powers it. I don't really see how a company is going to grow if they stop selling gas-powered vehicles and only sell electric vehicles. For GM, what they really need to do is capture a bigger market share of electric vehicles than they currently have for internal combustion engines to grow. I do like some of what I see with the new design in the Bolt, but I think they really need to ramp up marketing to bring some attention to all the improvements they've made. The Hummer EV and Lyriq seem like interesting vehicles, and usually more expensive vehicles provide more profit margin to the manufacturers. However, they're going to need to sell a lot of these to really grow their bottom line. Now, I don't own any shares of GM, and I don't plan to do so right now. I just think right now that I'm looking for companies with a little more growth for better long-term gains. Now, if you're somebody looking for less volatility in a stock, this could be a good one to own. I've got plenty of time before retirement, so volatility really doesn't matter too much for me, especially if I know the business has strong underlying fundamentals and will certainly recover. But this situation isn't for everybody. Okay, so that's the video. If you liked it, make sure you subscribe and hit the bell notification so you know whenever I upload a new video. And as always, thanks for watching.